Should you use a stop loss when you trade? I want to show you some stats and let you decide for yourself. I want to present some evidence for the case of not using a stop loss intraday for a day trade strategy. This is my Cobra III NQ. It's one of my top strategies, going over 1 year with $25 round turn slippage and commission. These are good results to make $11,000 per contract over a year with a $5,600 drawdown. These are good trading results, and this is what real world trading systems tend to look like, with slippage and commission and volatility in the markets. Now notice how the average trade profit is $98. That's with $25 round turn slippage and commission, and the net profit as a percentage drawdown is 196. What happens though? You see this percent probability is 35%. We have a 30-point stop loss. Now we have really high VIX levels, and we have to consider what to do as the market moves forward if these higher VIX levels will persist. I want to show you a daily chart of the VIX. We're looking at this daily chart of the VIX, and then we're going to take a look at options of potentially increasing the stop loss or trading without a stop loss, or a different mindset about stop losses. So this is the VIX. This is going back a daily chart. You see a much higher sustained level of VIX during this pandemic than we've had in any of these other VIX spikes. These come right back down. Here's a VIX spike. Here's a VIX spike. They come down really quick, but now we're just kind of in this island. Much higher levels of volatility. You know, we've seen decreasing VIX over the years, and now are we going to stay at these higher levels of volatility? We also see higher margins from the exchange, much higher margins, and so at some point, as equity prices go higher, the daily dollar ranges are going to get larger and the margins are going to get bigger. And you have micro contracts, and you also have the option of trading with bigger stop losses or no stop losses. So I want to go over this and show you what this strategy looks like. Cobra III E-mini NASDAQ without a stop loss. I'm going to turn the stop loss off, and you say that's crazy to trade without a stop loss, but one of the things I want you to consider is using a worst case drawdown as the stop loss and not an intraday stop loss. We want to focus on long-term results. We're not focused on the day-to-day. We don't need to make money. We don't need to go in on Friday and see our account, or go in on Monday and see our account up by Friday with these types of strategies, because we can't predict the type of market we're in, and we take advantage of what the market gives us, and it doesn't always give us what we want. And so this is the type of strategy we could consider removing the stop loss, using the worst case drawdown as the stop loss. I'm going to take out the stop loss and then show you the performance summary. This will double. This will go up by a factor of 4, and I want to show you that. So you see it goes from 11.9 to 47K over the past year. It goes from 98 to 424, and this doubles from around 198 to 396. Now your max drawdown goes up by a factor of 2 as well. So one of the things you could do, if you're trading 2 E-minis, you could trade 1, or if you're trading 1 E-mini, you could trade 3 to 5 micros. But you're really focused on the net profit as a percentage of drawdown, and then using the worst case drawdown as a stop loss. So if you traded, for example, 5 micros, you would risk about $6,000, and you'd be focused on this number, and you would just not have a stop loss during the day. And you know, that's what you'd have to consider when trading higher volatility levels. This takes 1 trade per day, and many times we get stopped out and we need about a $2,000 or $3,000 stop loss, and the market will reverse and go in our favor. And so those are the types of volatility levels. Those are the things we have to consider as we go forward in the future. What if the NASDAQ was at 20 or 30,000? A 30-point stop loss would be, you know, at 20,000, a 30-point stop loss would be half the distance. It would be like a 15-point stop loss now, because on a percentage basis. If the NASDAQ was at 30,000, it would be like a 10-point stop loss now. And so it could be the stop losses can be too tight if you keep the stop losses the same as volatility increases. So you have the micros now, and you have the option to decrease. And so that's one of the things I wanted to show you. Here's the equity curve as well, and you can see most of this is in 2020, since February 2020. If you just look at 2020, the average trade profit is nearly $700 average trade profit. And so what will the future hold? We see, recently the market has slowed down. We're still getting 100-point ranges in the E-mini S&P and 200 and 300-point ranges in the NASDAQ. And so volatility remains at a sustained high level, as well as the margin requirements. And so wanted to share that with you. One way to double your net profit as a percentage of drawdown is use your max drawdown as a stop loss, and forget about your intraday stop loss. And you see your largest losing trade is about halfway to a max drawdown. And if you want to cut that in half, trade the micros. So that's what I wanted to share with you today. If you don't like getting stopped out, if you feel paranoid about getting your stops run, and you want to find a strategy, this is a strategy, a technique, an approach. You put a stop loss on the system and not on the trade.